Hello, I'm Judy Woodruff. 1 year after the meltdown on Wall Street, Washington has still not addressed the problems underlying the financial system that allowed the crisis to happen in the first place. Two freshman senators from opposite sides of the aisle have teamed up to try to help shape legislation, largely because of their successful business backgrounds. I sat down with Democrat Mark Warner and Republican Bob Corker here on Capitol Hill. I talked with the two influential members of the Senate Banking Committee about how to reform the multi-billion-dollar financial system. Senator Warner of Virginia, Senator Corker of Tennessee, thank you very much for talking with us.
Thank you.
Thank you. Good to be with you.
Let me ask you, is the Senate going to do something to pass legislation to reform the United States financial institutions? If so, when? And if not, does that mean partisan differences got in the way again? Senator Corker.
I think we will do something. I think that all of us understand that as it relates to this last financial crisis, there's nothing that we're going to do in passing regulation now that's going to affect that. And in many ways, the further we're able to look at what happened in the rearview mirror and understand some of the driving forces even more fully, that's actually better. So there's nothing we're going to do. Mark and I have a bill to deal with resolution. I think that's the most important piece of financial regulation is what do you do with a failed institution?
What do you think the prospects are overall?
Well, I think the prospects remain pretty good. It will probably not happen as quickly as I would like, but I think it will happen. I'm an ardent free market capitalist, but even as a free market capitalist, you've got to have rules of the road. And we saw last year that in over half of our financial industry had no rules of the road at all, and there weren't appropriate rules, for example, on this bill that Bob and I put together in terms of how you unwind an institution, allow it to fail, allow the shareholders and the management to take the hit and not be propped up by the government.
What do you think the Banking Committee is going to do on this question of creating a government regulator for systemic risk in these large financial institutions?
Well, you know, it's interesting. I was at dinner Friday night in Tennessee, and I finally, after 3 weeks, got from Chairman Bernanke a description of what systemic risk was. So it was a long time coming. I mean, it's very difficult, I think, to define what systemic risk is. I think Mark seems to have had some concerns about that, too. And I think that when you give expansive regulatory ability to an entity, and yet you don't know exactly what it is, where that migrates to, I think there's some concerns there.
What do you see the committee doing on that?
I actually think that we will act here. You know, nobody would have anticipated AIG posing systemic risk, but if there had been someone looking kind of above the stovepipe approach, looking across the various regulatory boxes, I think perhaps we would have been able to get in advance of this crisis we just went through. And a lot of that will mean added capital requirements. It will mean trying to make sure that if an institution takes riskier behavior, there's a higher price to pay for that, again, in terms of capital.
By the way, I do think we'll address it, too. I think it's too much in the political mainstream not to. I think we'll address it in a weakened way from the way that the administration has put it forth.
Too big to fail. For all the criticism, this really is still, Senator Warner, the de facto policy, isn't it? I mean, is this government really going to stand by and let a Goldman Sachs or another huge bank go under in this country?
We've got to put in place an ability to allow these institutions, if they get into trouble, to fail in an orderly fashion, not to go into conservatorship, not to go into some kind of being propped up forever, but actually go with the receivership, find a way if there's certain part of their institution that is important systemically, allow that perhaps to be maintained, but allow the market to work and the shareholders and the management that took the undue risk and gotten themselves in a tough spot to be able to take most of the pain and not the shareholders, or not the taxpayers.
How do you see the too big to fail?
I think it's the most important issue we're going to address. I think it sets the entire culture of the large financial institutions going forward. It really determines how people are going to invest in these entities. I hate to beat an almost dead horse, but we've seen what happened with Fannie and Freddie and people believing that they weren't going to fail, and then you know, what's happened to taxpayers there. And my guess is at the end of the day, we're going to be successful in ending any thought of an organization being too big to fail. I think there's too much momentum on both sides of the aisle.
Just this week, the British government forced the Royal Bank of Scotland to sell off subsidiaries as a condition for getting more government aid. Should the U.S. government, under any circumstances, force a breakup of some of these big U.S. banks that are right now too big to fail? Senator Corker?
Well, I think, again, you get back to talking about what the systemic regulator does. I assume that if an entity felt like an entity like Citi, for instance, was too big to manage itself, that's one of the abilities it might have, and I think, again, we need to tread very carefully into that, because it very much changes the dynamic that we have in this country.
And I guess I would add that it's hard to draw an arbitrary monetary cap on the size, and you do need some institutions that have got in a global economy that can compete against other large global firms. I mean, Volcker has even gone to the point of saying that some of these firms should be prohibited, in effect, not go back to Glass-Steagall, but to prohibit a bank from having its own major trading operation. Alan Greenspan has even talked about perhaps breaking up or limiting the size of certain firms.
When we come back, should the Fed have more power? Sheila Bair, Republican-appointed head of the FDIC, won plaudits from a number of Democrats, but she's not been a favorite of the former Treasury Secretary, Hank Paulson, or the current Treasury Secretary, Tim Geithner. What sort of a job do you think she's been doing?
I think Sheila Bair's been doing a very good job. I think she has she's been that independent voice, been willing to step up against both Democratic and Republican administrations. I think if you there's not been a lot of bright lights in terms of the overall regulatory structure and how they've performed in a lot of areas over the last year and a half. I think the FDIC net has probably performed as well as anyone, and that process of resolving small and mid-sized banks has actually worked. And while we've gone through more bank dissolutions and resolutions than we would normally see, and she's got a proposal right now to kind of restore her coffers a little bit in terms of that insurance fund, I think she's been one of the institutions that, and her leadership has been independent, determined, and bold.
What's your take on Sheila Bair?
I'm a big fan. Look, I know her, many of her associates, other regulators, sometimes they might put her in the category of doesn't play well with others. I think that's the part about her that maybe I like most. She says what's on her mind. She's been very effective. I think she's shed a great deal of very constructive light on this entire process, and I think she deserves accolades from both sides of the aisle.
And what about Chairwoman Bair's proposal to have the big financial companies prepay into a kind of a resolution fund that would be used to deal with the crisis if it happened? What do you think?
Well, again, what does that fund do? And this is where...
And the administration's against this, by the way.
Well, what they're against, I think, again, and this is what I was getting ready to allude to, this is where Mark and I have reached a lot of common ground, and that is we don't want a firm to be able to be conserved. Okay, we want a firm, if it's dealt with, to be received, meaning that it goes out of business if it fails, and I think that's why the administration has opposed what she's done. And
who's right on this? Is she right, or is the administration?
Well, I think Sheila Bair is right. I think that the administration's approach, which is post-event assessment of fees, one would mean that the bad acting party would have gotten away scotch-free on this. I think actually having an amount of prepaid fees and recognizing again that the deposits will be insured under the FDIC component. The bank holding company, and again, most we're talking about bank holding companies in this circumstance, there may be need to have some dollars to keep them operating for some period of time so they can do an appropriate wind down and an orderly wind down. There may be a piece of their business that has to be, from a systemically important standpoint, that might need to be redeposited or sold off to an ongoing institution. And so consequently, the amount of fees that would have to be raised would really just be an ability to keep an operation running for some period of time because your deposits would still be covered by the FDIC insurance. So I don't think we're talking about a dollar volume that would be an undue burden on these bank holding companies at this point. And remember, if we got into another crisis and you had to do a post-crisis assessment, chances are the institutions would all be in tough times again. They would all complain about that assessment at that point. Why not go ahead and have these fees assessed during the good times? Again, I echo what Bob has said, that we have too many of our policies are pro-cyclical. We need to have some of these additional fees or penalties pop up during the good times and not just during the bad times. And so I think our approach is the right one.
You both, I think both of you have mentioned the Federal Reserve. My question is, what kind of job do you think it's done over the last few years, and should it have more power?
Ben Bernanke, I think, has done a good job as chairman. I'm glad to see the president reappointing him. I think on monetary policy, they've done a pretty good job. On prudential oversight and consumer, I think they've not done a very good job, and consequently, I'm reluctant to give them more power in those areas.
So I'm a fan of Ben Bernanke's. I think he would admit that they have failed from the standpoint of supervision. I do think that the monetary policy side he's done a good job of. The thing I appreciate most about Ben Bernanke is he wakes up every day. He does not have a political cell in his body. I do think he tries to call them like he sees them. You could have a Fed chairman that had a political agenda, and it could be a disaster for this country.
Quick question. The Federal Reserve regional bank presidents are appointed by the very industry, essentially, that they regulate. Are these jobs that should be confirmed by the Senate?
Possibly. I don't think we've really spent a lot of time looking at that whole process, but I think your point is well made and potentially something we'll take up during this process, but it hadn't been focused on.
I haven't really thought it through that well. I think prior to this time, other than the possible conflicts that seemed to arose last time in New York, it's not proven to be a problem, but it needs to get a re-examination.
A return to Glass-Steagall after the break. Executive compensation. It seems that Wall Street is back to the golden days. Big bonuses, huge bonuses being handed out. Is this, Senator Warner, the marketplace at work, or should the government be concerned?
Listen, I'm proud to be able to make a lot of money when I was in business, but when I did that, it was because I profited when my companies that I invested in or led profited. I do think we need a compensation structure that is more tied to the long-term performance of the entity you work for and not simply tied to quarterly earnings and the kind of quick flips that has characterized a lot of Wall Street's compensation. I actually do think there's a middle ground here. I wish Wall Street would be a little more cooperative and collaborative on this. I get a little fearsome when you've got a compensation czar setting kind of arbitrary targets. But if Wall Street doesn't come to the table and realize they've got a problem, both a perception problem in terms of the general public and a problem making sure that their compensation is tied to the long-term performance of the institutions they work for, you're going to see populist anger take over and government step in.
Compensation? I
think a distinction needs to be made between those firms that have taken federal money. They're in a whole different pot, and hopefully the message, the thing they've learned is stay away from the federal government, okay? But if they've taken federal dollars, I think that's one thing. But to have us moving out into other companies that have not, to me, is incredibly un-American. I think that, for the regulators to see some excessive risk-taking taking place and question that, saying that you've set up compensation mechanisms that we are concerned about as it relates to the stability of your organization, I think it's fine for them to talk about that on a principles base. But to actually put nominal amounts, to me, is way out of bounds.
I want to ask each of you a different question at this point. Senator Corker first. We've seen in the United States over the last year the government in an unprecedented way get involved in markets, in business, in a way we haven't seen since the Great Depression. Was this something that saved us from economic catastrophe, or is this something that is creating problems that are just going to get worse down the road?
No matter what the original intent was back when TARP was passed, what's happened has been incredibly abusive. I supported TARP when it first came forth. Mark wasn't here yet. But what I've learned from this is, and I told Hank Paulson the other night, I was on a flight with him to New York, it just happened to be on the same plane. I have such a distrust now, because what happened was this TARP program has now turned into a stimulus program. It first became a slush fund to basically do industrial policy. Now it's become nothing but a stimulus plan. I mean, the administration's using this to really stimulate the economy. So there's no question that we have created a monster in all of this.
Different question for you, Senator Warner, and this gets back to something I think you touched on earlier, and that's Paul Volcker, probably one of the most respected people on the planet when it comes to the economy and financial matters. He's made it clear that he thinks the proposed Obama financial reforms don't go far enough. He argues if you don't go back to Glass-Steagall regulation, you ought to at least go much further in cracking down on these big banks. Does he have a point?
I think he's got a point in that it'd be great to go back to pre-1999 and maybe have some of these limitations in place. But the notion that we're going to unscramble and unwind these multinational, complex financial institutions, I just don't think is going to come to pass. And I do think you might then have flight to those countries that would still allow those kind of multiple holdings to take place. I think the way you get at it is higher capital requirements. I think the way you get at it is risky behavior is going to cost you more in terms of capital backstops. I think the way you get at it is trying to have these dissolution plans put in place. I would differ with Bob a little bit on the TARP. I think it wasn't just the United States that acted. Obviously, the UK acted, and most of the industrial world acted in terms of government funds invested at a moment of crisis. I think actually history will treat both Secretary Paulson, Secretary Geithner, and Chairman Bernanke pretty well with acting at a time when the alternative could have been an absolute total financial meltdown.
Up next, bipartisanship in the Senate. Senator Warner, on this point of partisanship, do you think the Democrats made a mistake back earlier this year in February in not bringing the Republicans on board with stimulus legislation and thus setting a partisan tone?
Well, I think the president reached out a great deal. And I was part of that working group working with the Republicans to try to get a compromise that would have been, I think, a better stimulus package. And we saw that group decreased to what ended up with only 3. I think there were more members who would have liked to have been part of that group but felt enormous pressure not to be supported. Where I think the administration did make a mistake, though, was I wish after that stimulus vote, where I think the kind of reaching out at least was curtailed a little bit, I wish they would have continued. Because at the end of the day, if the president kept reaching out, you would have either gotten more members to say, hey, I will go with him, or they would have been viewed as perhaps just saying no. And I think the American people want to see us reach that common ground. So I do think they reached out on stimulus. I think they curtailed afterwards. I wish they would do more.
Last question for both of you. Senator Corker, is there one other Democrat you could name in the Senate you've grown to really respect and that you think you can work with to get business done this year?
Oh gosh, it depends on the issue. Yes, in every category. I'm on the Foreign Relations Committee, and I've co-sponsored legislation with Kerry. I've co-sponsored legislation with Menendez. I've co-sponsored legislation with Dodd. On the Energy Committee, I've worked a lot with people like Dorgan, Maria Cantwell, Blanche Lincoln, Mary Landrieu. So yes, I've co-sponsored and worked with many. Again, on the committees, and we're on a committee together, you establish a relationship. What happens in the committee hearings is you'll see the input. Mark may see it in me, I may see it in him. You'll see the input taking place. You realize you have common ground. And again, look, I can count. We have 40 Republicans. If I want anything to happen, I've got to find someone on the other side that shares my views on a particular issue. And sometimes back home, people don't understand that. And they hear us talking about bipartisanship, and that concerns them. But they don't understand, in some cases, if we're going to get anything done in this body, it's going to have to be done in a bipartisan way. And I came here to solve our nation's problems. I didn't come here just to say no on every issue.
Same question for you, Senator Warner. Are there Republicans you've identified you respect and you expect
Absolutely.
you can work with?
I mean, on the banking committee, I've been able to, I think, develop a relationship with Richard Shelby, who we share a lot of common views. I've worked very closely with Judd Gregg on a series of budget issues, and I think he's got a lot of good ideas about trying to strike a grand bargain with the American people about major entitlement reform. I come from a state that reaffirmed again just recently in elections that it tends to be a moderate to conservative state. I'm used to taking flack from both sides, and at the end of the day, I think the American people expect us to come here and find that common ground, because I think they don't see most issues through the D&R lens, and particularly at this moment of crisis for our country, not just about financial, but health care, energy, the host of issues we got to confront. A lot more of this kind of reaching across the aisle, I think they'd like to see more of it.
On that note, we will thank both of you, Senator Mark Warner, Senator Bob Corker. We appreciate it. And that's our conversation with Senators Mark Warner and Bob Corker. I'm Judy Woodruff. Thank you for watching.